Good morning, everyone. Team, am I audible? Is the screen visible? Good morning, everyone. All right, so let's begin. Today is the final day, day 5 of our revision sessions. For those of you who are new here, I am Paritosh Panchal, and we have been doing a 5-day revision session for AFM, wherein the first day we discuss certain exam tips and tricks. And then in the following days, we discuss certain topics as well as did section B style of question. Now, today we were to do mock, but with your feedback, we decided that we shall go ahead with section A questions. So we'll do two section A questions instead of the mock because we have anyways done section B questions, 2 questions per topic already. And now let's just see how to go around section A style of questions, right? So these are the typical instructions that you would get in the exam. Okay. So you could go through these. If you want this document, we will share it across with you. It's a 3 hour, 15-minute paper. Section A, 50 marks, and section B, 25 marks of each. Okay. And some more instructions, right? So let's begin. Section A, question 1. Now, again, we are going to do both section A questions only. So, but I just shared this so that you get to know how the whole thing would be. You get a little bit of idea about it. Okay. So the following exhibits, now before reading anything, we shall read the requirements. This is a 50-mark question. Now, we won't dwell much on the theory answer because it's already written and it's pretty straightforward. So I think you could just read through it. I'll just briefly explain it to you. And we shall spend a little more time on the calculations and explaining you how the calculations are done. So the questions are: discuss the feasibility and effectiveness of defense strategy of selling off an individual garden center and enhancing directors' remuneration. So we are talking about defense strategies. So I guess somebody wants to buy them off and they want to defend themselves by selling certain garden centers and enhancing directors' remuneration. So directors' remuneration would basically mean that you are increasing the financial burden, as in you are starting to pay your directors much more money, right? So since their remunerations have increased, so that may maybe discourage somebody who wants to buy your company because they would have to continue paying those high salaries to your director or prematurely terminate them and compensate them accordingly. So that could be a little deterring to them. um, However, so this is the intention, but however, it may not go along that way. What if the other company is prepared to pay such a high salary? Then it defeats the purpose. Okay. The other strategy they are suggesting is selling off garden centers. Now, we don't know what exactly this is. When we read the question, we would get to understand that better. Excuse me. Prepare a report on the board of directors of Kingdom Company. So, as we know that Section A involves creating a report. Wait, let me just zoom this in for you. Right, Section A involves typically preparing a report, and there are marks for just the structure of the report. Now, within the report, we have to estimate the company's cost of capital before new bonds were issued, estimate the market value and post-tax cost of debt of the new bonds, and estimate the revised cost of equity and revised cost of capital if the bonds are issued. Discuss the impact on Kingpin's company cost of capital and the reaction of equity and bondholders to the chief executive's proposal. The discussion should include an explanation of any assumptions made in the estimates in subsection B, subsection 1 and 3 above. discuss the approach taken to employee remuneration by Kingdom's northern region and in the issues associated with it. This is kind of vague, but over here we at least understand, okay, we have to calculate a bunch of individual costs and then the overall cost of capital and the whole reaction of the equity holders as well as the bond providers to whatever capital we are raising or whatever is the impact on WACC. Right. So now the question begins. Okay, let's read this. The following screen. Okay, so this is just the summary of what all information they are providing. So exhibit one. Okay, one more thing. Professional marks, 10 marks. Okay, so these all contribute 40 marks of the question. Now, Kingdom Company is a nationwide chain of garden centers selling products such as plants, fertilizers, tools, and garden furniture. It was established 20 years ago by the current team of executive directors and achieved a listing on its local stock market 4 years ago. Since listing, the company has made consistent profit and has been able to increase its dividend each year. The executive directors collectively own between them 25% of issued share capital. The remaining shares are held by a number of investors, with none of them owning more than 10% of issued share capital. Okay, so we understand this is a pretty old company. It's a 20-year-old company. However, the listing was done 4 years ago. One good thing is the founding members are still the directors over here, but they own only 25% of the company, and the remaining is owned by investors. But none of them holds 10% of the issued capital. So, majority stakeholder probably would still remain to be the directors who are taking the decision. Just a moment. Sorry. Um, yeah. So none of them owns more than 10%. So 25% owned by the directors and the balance 75% by institutions. Now, two of Kingdom's major competitors have been taken over in the last 2 years. Media coverage suggests that further takeovers are possible. Potential acquirers include other chain of garden centers, property developers, and supermarket chain looking to diversify their business into profitable garden center sectors. As yet, no potential acquirer has approached Kingdom to buy the whole chain, although Kingdom has had inquiries from other businesses wanting to purchase individual garden centers. Kingdom Company can sell a number of individual garden sectors without threatening its continued existence. So, of late in the market, a lot of their competitors are being purchased over by probably larger players or well, it's a range. So there are either larger garden center chains, or property developers or supermarkets. Okay, so variety of people are buying smaller competitors. Okay, so we are a little concerned that maybe somebody would buy us off or buy Kingdom Company off. And in fact, there have been certain inquiries, um, but not to buy the entire company, but to buy a particular garden center. So Kingdom has that ability to sell off one center without threatening its own existence. So they are able to do that. Okay. Um, Now, Exhibit 2. Kingdom Company's executive directors remain committed to the business. They are fearful of a takeover, believing that the new owners will want some or all of them to leave the company. They have therefore been considering possible defenses against a takeover bid. Kingdom Company's chief executive has received two proposals from the director. Uh, Is there a lag? Wait, right. Just a moment. Is it better now? I just switched my Wi-Fi. Just a moment. Just a moment. Just a moment. Okay, I think it is. uh, Okay, I think I can see the net is stable now. Sorry about that, guys. Um, where were we? Yeah, so yeah, there have been inquiries to buy individual centers, and Kingdom is able to do that without threatening its corporate existence. Exhibit 2. Kingdom Company's executive directors remain committed to the business. They are fearful of a takeover, believing that the new owners will want some or all of them to leave the company. They have therefore been considering possible defense against takeover bid. Kingdom Company's chief executive have received two proposals from the director. So the directors are the original directors from the very beginning. Now they are a little concerned that maybe, okay, after just a moment, let me just zoom this in further. Better? Yeah. So they are concerned that maybe whoever new is going to purchase the company may not want the directors, the founding directors, to continue. Maybe they would ask all of them, or maybe a few of them, to leave. So they don't want anyone to take over the company and start taking these decisions. So they have submitted two proposals to discourage or to protect themselves from being taken over. So defense strategies, basically. For strategy number one is sell individual garden centers, which would particularly be attractive to purchasers. That is, disposal of these centers would make Kingdom Company overall a less attractive purchase. So this is your classic poison pills sort of strategy where you are selling the crown jewel of the company. The most attractive garden centers are being sold, so now you are no longer that attractive. So basically, your prime properties, you are selling it away, right? Why? To make yourself unattractive so that any bigger company is no longer interested in you. But you are sacrificing on your end as well. Okay, it's poison pill. You are basically swallowing that self-damaging pill, right? Um, so there was a question, if you remember, in the requirement which spoke about these two strategies. Now it makes sense what they were talking about. So it is a clear case of poison pill strategy. So you can say that this strategy will for sure work, especially when Kingdom has the ability to sell individual garden centers without threatening its corporate existence. So they are able to do it, and this would most definitely deter the potential buyer. Okay. However, when we sell these centers, we will get a lot of cash in hand. Now, it depends what we do with this cash. If we keep the cash within the company, we become a very cash rich company. So maybe that could attract potential buyers because they would see that, oh, this company has a lot of cash, so they can utilize this cash later on. Okay. Or you could give it to your shareholders as a special dividend. The shareholders would be happy that way, that they are getting some return. However, it could go both the ways, because certain shareholders would also think that, why is the company giving us such a huge dividend? Can't it invest it somewhere? Okay. So we have to look at every point from all different angles. You have to think very practically. Uh, like, you imagine yourself to be in the real world. Whatever action you take, the implication won't be just one. You have to look at that action from several different angles or several lenses. Okay. So yes, it is a good defense mechanism, but so you first write that it is a good defense mechanism. You talk about poison pill strategy or selling the crown jewel strategy. But then you also say that in this particular case, if you sell it, you get a lot of money. What are you going to do with the money? Okay, if you distribute the money as dividends, then the shareholders would think that, well, couldn't it reinvest it somewhere and make some good returns out of it? Okay, certain shareholders would be happy about it. Certain shareholders may not be happy about it. So you speak from, or you view it from both the angles. The other alternative of this cash is reinvest it. The other alternative of the cash is just keep it in your reserves. But again, if you keep it in your reserves, you could get attractive, right? So that could maybe defeat the purpose. So you just highlight all the different angles. And the next one is pay the executive directors higher remuneration. So this we already discussed when we were looking at the requirements, that yes, it would deter them, okay, deter the buyer, possibly, that they may not necessarily want to pay the directors that higher salary. So, okay, let's just read it first. Pay the executive directors higher remuneration and change their contracts so that they would receive much higher compensation for loss of office if their contracts were terminated early. Okay, so for early termination, they are including a penalty. And so maybe it could work, but we cannot rule out the possibility that the buyer would be willing, like since they are paying any which way so much money to purchase a company, a little more extra, a few $1 million here and there extra, just to, maybe they wouldn't mind paying if they want to terminate these directors early, or they would continue having these directors. We never know. This is just the directors' anticipation or their fear that they may be removed, but what if they are asked to continue? Okay. And what happens then is they just get more money for the same amount of job. So it's not really thinking from a shareholder's perspective. This is very this is the directors being very selfish and thinking from their only perspective. So you can talk about all these things. Again, the solution I have written in this sheet. So I will share the sheet with you. If you don't get it, just comment down below and my team will reach out to you. You can share your email ID with the team and they shall send this sheet over to you. Right? Um, so where were we? Yeah, so the executive higher pay and higher compensation if they get terminated early. Kingdom's chief executive believes, however, that any defense Kingdom adopts should also strengthen the company's future. She is therefore proposing to expand the company's current limited sales of camping products in its garden centers by establishing a chain of Kingdom outdoor shops selling camping, walking, and outdoor equipment. The outdoor retail sector is competitive, but the chief executive believes that Kingdom will be successful. The establishment of chain of outdoor shops will be funded solely by debt, the idea being that changing Kingdom Company's financial structure by having significantly more debt would make it less attractive to acquirers. So, the above two, which we just discussed, were proposals given by the director. However, the chief executive has also given a proposal, and it kind of makes sense because she is of the opinion that whatever strategy we do to protect ourselves from being taken over should also benefit the company in the long run, right? Um, so she suggests, why don't we enter into a different business altogether? Okay, she's suggesting that we expand into outdoor equipments along with the current garden centers that we are selling. And when we are uh, what she also mentions is this outdoor retail sector is pretty competitive, but she believes we can do it. Now, we don't have any base as to believing that they will be successful. It's just that she believes personally that it will be successful. Okay, but she does mention it is competitive. So we could be a skeptic over here and challenge this assumption. Okay, the line says the chief executive, the outdoor retail sector is competitive, but the chief executive believes that Kingdom Company will be successful. But on what grounds? We may not necessarily have the necessary skill set to carry on the outdoor business. Okay, because our management is skilled in the garden center business and we have been doing it for the last 20 years. This sector is new to us. So it's a see, just like anything new you do, you may or may not succeed. Okay. Uh, but that only time can say. We can't be 100% sure that the business is going to be successful. Also, the risk changes. Exhibit number 3. Kingdom Company currently has 25 million $1 share. Okay, so number of shares is 25 million. The face value is $1. With the current share price of $5.56 per share. So market value is available. It also has 0.5 million, sorry, 0.45 million of 6.5% bonds in issue. Each 6.5% bond has a nominal value of $100 and is currently trading at $104 per $100. The premium on the redemption of the bonds in 3 years' time is 2%. So redemption is at a premium. The market value of the bond is given, face value is given, coupon is given. Based on the yield to maturity approach, the after tax cost of bonds is 4.1%. So, after tax cost of bonds, so post tax cost of debt is also available. Kingdom's quoted equity beta for its existing garden center business is 0.9. So, we have been given the existing equity beta, but we are changing business. So, we may have to recalculate this, not changing, but expanding. Okay, into outdoor centers, so that may have a different beta. Kingdom plans to issue zero point 0.6 million 7.5% new bonds, each with a nominal value of $100. These bonds will be redeemable in 4 years' time at a premium of 8%. The coupon on these bonds will be payable on annual basis. These bonds are anticipated to be have a credit rating of triple B. The issue of the new 7.5% bond will not affect the market value of Kingdom shares or the existing 6.5% bonds. So now this assumption which they have, or this information which they have given, we can display our commercial acumen over here by saying that, the moment you issue new bonds, okay, financial risk increases. So, since financial risk increases, the shareholders would want higher returns. Okay, because the business, the risk, since the financial risk is increasing, the cost of equity would go up, and that is going to change the price of equity. Okay, so this is not practical what they have written, that it's not going to affect the market value of Kingdom or not going to affect the market value of existing bonds. Obviously it is going to affect the market value of existing bonds, especially when you are issuing new bonds at a higher coupon. Okay, if you are issuing 7.5% bond, the existing bondholder at 6.5% would say that, hey, we want the new bond because we are going to earn more. So they're going to sell the old bonds and they are going to purchase the new bonds. So when they sell the old bonds, like one person, all the bondholders would think that way. Everybody would want to sell the old bond. That means selling pressure builds up, which brings the prices down. Okay. Since the price of the bond changes, then the yield will be almost equal to the new bond's yield. Okay. So price does change. Right, so practically you need to show that commercial acumen. Okay, you are a professional now, though they have not asked us any question relating to this particular assumption, but we still mention about this. So yeah, all information about equity and bonds have been given, new, old. The market value of new bonds will be determined by using the information relating to Kingdom's credit rating and the 4 bonds which the government has issued to estimate Kingdom's yield curve. All the bonds are of the same risk class. So different bonds are there, annual yields are there, and different years are there. So this is the yield curve basically. Um, Credit spreads shown in the basis points are as follows for a triple B rated company or a triple B rated bond, which is our bond. These are the spreads. So these are like your base rate, okay, and then you can add the spreads to those rates, right? Kingdom plans to invest $60 million in non-current assets for outdoor shops. So this is the investment required and outflow, not which includes, or rather they are asking us to ignore working capital, but again we need to show our commercial acumen, saying that we may require additional investment in working capital. Currently, Kingdom Company's non-current assets have a net book value of $150 million. It is assumed that the proportion of the book value of non-current assets which will be invested in the outdoor shops and the garden centers will give a fair representation of the size of each business within Kingdom Company. The asset beta of similar company in the outdoor retail sector is assumed to be 0.88. So the existing assets, that is garden center asset, is worth 150 million, and the new business, their asset is worth $60 million. Now here they have given us book value, okay, and 60 million is basically you are purchasing new assets, so it's more close to its market value. We honestly don't know what the market value of this 150 million is, so you could talk about it in your answer. Okay, and also they are saying that it gives you a fair representation of each business. So this is an assumption that we are making. In fact, it is given over here. Just a moment. Just drinking some water. Yeah. So in fact, it has been given over here that we assume that the size of the companies will be in these proportion. So 150 is to 60. Okay. Now the asset beta of a similar outdoor retail sector is being given to be 0.88. So now there are two business sectors in our business. We already have the equity beta of the old garden center business. Now we can use this 0.88 as the new proxy beta, but we will have to ungear it and regear it as per our capital structure. Before taking into consideration the impact of this investment, Kingdom's forecasted pre-tax earnings for the coming year is $24 million. It is estimated that the new investment will make a 10% pre-tax return, and after-tax earnings will increase by $1.1 million. The corporate tax rate applicable to all companies is 25% per year. The current risk-free rate of return is estimated to be 4%, and the market premium is 9%. So it's market premium, not market return. So that is RM minus RF. RF is given, RM minus RF is given, tax is given, um, and they are talking about the returns that we will earn in coming years, and how much it will, if the it is estimated that the new investment will make, so how much we are going to get from the new business. Exhibit 4, Kingdom Company. I know, big question. It's a 50-mark question. Okay. That is why I suggested attempting section A first. It is a big question with a fresh mind. If you approach it, it will be easier to tackle it rather than spending already 1 hour, 1.5 hour in section B, being mentally exhausted and then dealing with this giant. Okay. Kingdom Company's annual report contains a general commitment to act with social responsibility in line with society's expectation. It also commits to paying its staff fairly in accordance with their responsibility and states that its staff are vital to its success. So we are committed, like in fact, it is written, it is in writing that we are committed to act with social responsibility, and we pay our staff fairly. So this could kind of like go a little against if we decide to increase the remuneration of our directors just because they are fearful that a take in if at all a takeover happens, which has not happened yet, but if at all it happens, they may be thrown out of the company, which again is a fear. They are just speculating it, which may not, even if they are taken over, the new company could decide to retain the original directors. Okay. So we are just paying them, or rather, the proposal is just to pay them extra because of this fear. So this kind of is not in line with what is written in our own annual report. To try to improve the situation of low-paid employees, the government has recommended a basic hourly wage as minimum level of employees should be paid. Although this minimum is not legally enforceable, A newspaper investigation has revealed that some staff in Kingdom's Company Garden Centre in the northern region of the country are paid up to 15% less per hour than the recommended minimum wage. Most of these staff are part time staff working limited hours each week. This brings us to the other theory question that we read earlier about employee remuneration, and it referred to this paragraph majorly and the following one: the manager of Kingdom Company's northern region. So what is happening is the government has in place certain minimum wage guidelines, and one of the journalists has discovered that Kingdom Company in one particular garden center in the northern region is not paying their staff even minimum wage. Now, minimum wage they are writing is not legally enforceable, but this is what the society would expect, especially when the government recommends that this is the minimum wage. That is what everybody will assume or would expect they would get, or their employees will be paid. Okay. However, Kingdom is paying 15% less per hour. Now, upon questioning, the manager of Kingdom Company's Northern Region Center, when asked to comment, stated that Kingdom Company had the obligation to its shareholders to control staff costs, lower pay levels where necessary to differentiate between staff, ensuring that the managers and the staff with experience and expertise were appropriately rewarded. The manager commented that the pay level also reflected the lower commitment to Kingdom Company, which part time staff made compared with full time staff. Now, this is the comment made by our manager. Some valid points, some not so valid points. So, yes, lower pay levels were necessary to differentiate between staff, ensuring managers and staff with experience and expertise were appropriately rewarded. Yes, if the staff is more experienced and has more qualification or expertise, then yes, you reward them more. But does that mean that the part time workers do not have the expertise? The second statement that he makes, that they may have lower commitment just because they are part time, that is not true. Or rather, that may not be necessarily be true. Because if somebody is working part time, who knows that in those few hours that they are dedicating to Kingdom Company, they are working with full commitment, right? They may be studying and working part time, or they may be doing something else. They would have certain obligations due to which they cannot take up full time job. Doesn't mean that you discriminate part time employees with full time employees, that just because if there are two staff members with equal expertise and experience, just one, since they are full time, they are being paid more, and the other being part time is paid less. That doesn't seem fair. Though minimum wages is not legally enforceable, as in the staff cannot sue us for paying below minimum wage, but which staff would want to continue? When, just imagine, put yourself in the position that you are to receive, for example, $10 an hour, but you receive 15% less. Okay, you receive 8.5 dollars an hour, and everyone else around you or your peers in different companies are earning $10 at least. You wouldn't be motivated to work in this company anymore, right? You would leave the company. So there is a huge risk of employees leaving the company and impacting the company. Okay. Also, it puts us in a bad light in the society, especially when we start making statements in our annual report that no, we are working for the betterment of the society, and that the society could say that the least you could do is pay your staff adequately. You are not doing that also. You in fact are discriminating on basis of their the on not on basis of expertise, but you are discriminating just on the simple reason that they are part time and not full time. Okay, so maybe the society could even decide to not buy our products as a way of protesting that the company needs to be paying their employees fairly. Okay, so it could lead to a lot of things. And in the midst of all this, if we come up with a proposal to increase directors' remuneration, then that's a big no-no. It would create all the more negative PR. And one other valid point that the manager does make, but then again, it's the manager's job to have balance these things out, because different stakeholders have different interests. So obviously, the shareholders would always want to reduce costs, but that does not mean that you start paying or you start discriminating amongst the part-time employees and pay them below minimum wage. That's the bare minimum that the government recommends. That's the least you should be giving them. Okay, so you could highlight these points. Again, the solution is written, you can go through it. Now let's start with our report. Uh, to the board of directors, Kingdom Company, from the finance manager, subject in one line: impact of the proposed investment in outdoor shops. A small introduction: the report indicates the impact of the proposed investment in outdoor shops and the consequent increase in debt finance. It also discusses the possible reactions of equity and bondholders to the proposal. Financial estimates provided in the appendixes are used to support the discussion, and assumptions underlying the estimates are set out below. Okay, so except for the last line, the initial one or two lines are from the requirements itself. So you could just pick up these things from the requirement. Okay, because like discuss the impact of Kingpin's cost. So we are mentioning that what the report is about. Okay, then we look at the cost of capital, that we were to find out what is happening to the cost of capital, the assumptions that we are making. Like, for example, we are assuming that we will be successful in the new business. We are assuming that we are using CAPM model. And within the CAPM model, it is assumed that the proxy beta would give a good indicator of the business risk. Okay, which may or may not be true. So, but we are highlighting that that's an inherent assumption that we make under CAPM, that the proxy beta's reflection of business risk is equal to the new business risk that we are taking. And then they also write that the other assumption we are making is the share price of the existing bonds and the market price of the shares and bonds remain unchanged, which may not necessarily be true. Okay, then we view the whole decision from the point of view of equity holder. Now, equity holder is just bothered about returns, how much returns they can make. Um, and the bondholders is majorly bothered about whether you can pay the interest and debt on time. Okay, and there is a brief conclusion: assuming a strong business case can be made for the investment and the estimates are robust, a Kingdom company may be able to justify financing it solely by debt and claim that the increase in financial risk is within acceptable levels. However, before committing to further debt, Kingdom must provide a clear plan for repayment of both the current and new bonds, or offer sufficient assurance that it will be able to refinance its debt when it is due for the repayment. So we are saying we can go ahead with it, but we are saying that we are assuming that a strong business case can be made, okay, for this new outdoor investment. And we are also assuming that the estimates which have been given in the case are pretty robust, are pretty on the safe side. Okay, we can rely on those. So have given these two, or assuming these two, only then can Kingdom justify financing it with debt? And the question about financial risk is that you could say that it's within acceptable limits. Now, all these conclusions are drawn based on the calculation, which we haven't done yet, but just giving you a brief overview as to how the report needs to be written. You can read through these things and structure your answer accordingly, right? Um, so this is from the equity point of view, and then from a debt point of view also, you are saying that we need to, before taking debt, we need to give a clear plan as to how do we intend to repay this debt. Okay, or give them some sort of assurance that maybe during, like, if the debt is to be paid after 5 years, then we have enough money to pay, or we can take fresh loans after 5 years to pay off the old loan. Okay, but we wouldn't know the terms. when we take that new issue of debt. Okay, right. So appendix number 1, estimate the company's cost of capital before the new bonds are issued. Now, in the paragraph, almost everything was given with regards to the new capital. So we were given the market value of the bonds. Okay, 25 million shares into $5.56 per share. And similarly, 0.45 million debt with $104 market value per issue. Okay, so that kind of like our the weightage, we arrive at 75% and 25%. That's how we find our weightage. So the market value of equity divided by the market value of the entire company. Okay, total value, right? And then we arrive at cost of capital. So cost of capital for equity, if we see, we have the risk-free rate, we have the equity premium, that is RM minus RF, and we have equity beta. This is estimate the company's cost before the new bonds are issued. So this is before we are expanding or anything like that. I think this is particularly asked in subsection 1. If you see the requirements, yeah, estimate the company's cost of capital before the new bonds are even issued. See, we issue the new bonds for the expansion project. So they are just asking us the existing WACC basically before any expansion or before any new bonds are issued. So over there, everything is given. Post-tax cost of debt is also given in the question. So this is pretty straightforward. These were easy. What do you say? How many marks were these for? Very, very simple. Yeah, 4 marks. Okay, very simple 4 marks to be scored. There is nothing which was not given in the question. Okay, that is why these big questions, though they are big, a lot of information is already available. Like just it's a simple whack. That too, you don't even necessarily have to, like, all the variables for cost of equity is given to you. You just have to put it in the formula. Post-tax cost of debt is given to you. Okay, market value is given to you. The debt is given to you, probably not directly, but you know that if you have been given the number of shares and number of bonds, and you are given the market value per share and per bond, then you can easily find the total market value. That's it. Find the weights and then find the WACC. Okay, that is weight into cost and the sum of all of them. So then we can say that the company's cost or the company's WACC is 10.1%. So just round it to 10% or just have one decimal space, 1 or 2 decimal is fine. Okay, so 10.1% is the WACC before the expansion or before new bonds are issued. Now, estimate the market value and post-tax cost of debt of the new bonds. So we don't have the market value of new bonds. However, they have given us the yield curve of the bonds, of government bonds rather. So we need to find, so see, the yield curve is given 4%, 4.3, 4.7, 5.2. This is given. Redeemable in how many years is given. Okay, and this is not double B, this is triple B, I guess. Yeah. So triple B credit spreads have been given. So with this, we can find our own corporate annual yield curve just by adding the pips, the spread to, so you take the base and you add the spread to it, and we get our own personal or our own corporate yield curve, right? And now if we have to look at the cash flow, so we are spending 7.5% as coupon. So this is pre-tax. Okay, so 7.5% is the interest paid on a face value of $100. So year 1, 2, 3, 7.5, 7.5, 7.5. And in the last year, not only do you get that 7.5, rather, let me put this in brackets so it's easy to understand. Okay, so not only do you get the interest, but you have to redeem the bonds at a 8% premium. Okay, so you are redeeming those bonds and now you are valuing them, that is, you are discounting them at your yield curve, the annual yield curve. So it is 7.5, that is the cash flow or a future cash flow, into 1 divided by 1 plus R being your 4.56 raised to the year N, 1 year. Okay, same thing, 2 years, 3 years, 4 years, and this is nothing but the summation of all, right? Oh, okay, this is not visible. Wait, let me just zoom out a little for you. Okay, yeah, visible now. Okay, thank you for flagging that. All right, so I'll just repeat myself. So these are your present values, right? This is the total present value. Okay, so 7.2 is nothing but the cash flow discounted with the yield raised to 1, right? So cash flow into 1 divided by 1 plus R being 4.5% raised to N being 1 year, and so on and so forth. This is how bond valuation is done using annual yield curve. I hope you remember it. If you don't, well, this acts like a revision. This is how you would value bonds. Okay, so this is our market value, 109.9 or almost $110. Okay, so the market value of new bonds, that is per bond unit price based on, you could just say market value per bond unit based on annual yield curve, is $109.92 million. Okay. Oh no, this is per bond, so it's not million, right? Number of bonds issued, well, they have already given in the question that we are issuing 0.6 million bonds. So the total market value of the bond is simply nothing but the number of bonds into the market value per bond, that equals 65.9 or almost $68 million, right? Then we can proceed to post-tax cost of new bonds. So we have the years and we need to find the cash flow. Now the cash flows have been given in the sense that we are finding the what do you say, cost of debt over here, cost of the new bond. So the cost of new bond, now since this is redeemable bonds, um, you just have to find the IRR. So you have your 0, 1, 2, 3, 4. So it's a 4-year bond. Okay, as we can see over here, 4-year bond. Year 0, the market value, you start off with the market value 109.92. Then there is interest. If you want the whole split, just show you the whole split of how this is done. So you have the market value of the bond to be 109. Okay. So $109.92 outflow. Then we have interest. Okay. And this coupon will be post-tax. Always remember, because we are looking at cost of debt from the company's point of view. So we want post-tax cost of debt. So is equal to 7.5% into $100 into 1 minus T. How much was tax? Tax, I think, was 20%. Let's see. Where's tax details given? Corporate tax is 25%, 0.25. You could directly write into 0.75 also, it works. $5.63. Okay, over here I took 2%, but it's actually 25, right? Did I read it correctly? Yeah, corporate tax rates applicable to all companies 25% per year. It's not 0.2, so that's a mistake. Small mistake, a minor mistake. So anyways, this is going to be our interest, and then redemption. Redemption is at a premium. Okay, so redemption is at $100 into 1 plus 8% premium you are redeeming it at, so 108. So it's nothing but the summation of all the cash flows, right? Okay, so our YTM is the IRR of all the cash flows, right? This is our final cash flows. Okay, so YTM is nothing but IRR, and since this is already post-tax, so this is basically our post-tax cost of debt of the new bond. So KD1 minus T. So we found the cost of new bonds, we have the cost of old debt. Also, the cost of equity is going to change because we are expanding into a new business, um, and altogether has a different business risk. So we would need to calculate that. So estimate the revised cost of equity and the revised cost of capital if the new bonds are issued. Okay, so we don't know the cost of equity, but we do know the cost of old bond, which is 4.1%, which you could cell reference it from here, 4.1%. And for the new bonds, we get it from here. Okay, the YTM that we just calculated. Just a moment, let me extend this. Yeah. Okay, we have the bond value. The new bond is worth 65.95. These are market values. The old bond, we have it from here. That is 46.8. So in fact, I can cell reference it here because why calculate it twice? Okay. And then the cost of equity again, sorry, a market value of equity again, we can reference it from here, right? So we could just say, where did it go? We've already done the calculation, so we can just reference it. The market values don't change. That's what they said. Despite the new bond issue, the market values don't change. The cost of old bond and cost of new bond, we have old bond doesn't change, new bond we calculated. Um, we find the weightages. Now the equity is something that we don't have. So let me just highlight this. Okay, this is something we don't have and we need to recalculate, right? Now, in order to calculate the cost of equity, we would have to get the new equity beta for the new business. We have the risk-free rate, we have the market premium, we have the equity beta of the garden center. Now, they have asked us to split the business as per the assets being invested. The new investment has 60 million in non-current assets, and the existing business, that is the garden center, has 150 million. Okay, now they have also mentioned that wait, is this visible? Yeah, they have also mentioned that 10% is the pre-tax return for the new outdoor business, whereas for the existing business it is 16%. How? You can see that, I think, yeah, they have given us that it is it's 10% return, so that's $6. And over here they have given us that there is a 24 million profit that is happening, so that technically works out to be 16%. So this 24 million is given in the question, and 16% is what we are calculating as a return. So we can see that the outdoor business is not as lucrative as the garden center. Now, only if the risks are lower will it justify it, but then would the existing shareholders be willing to take it up? Okay. Anyways, nonetheless, the total non-current assets after expansion is going to be $210 million. Um, it is assumed that the proportion of the book value of non-current assets which will be invested in the outdoor shop and the garden centers will give a fair representation of the size of each business within Kingdom Company. So I've just copy pasted this from the question, right? So now we have the value of equity. available to us. It's already there, so we get it from here. We have the value of debt also available to us, 46.8, right? Now, keep in mind, we are finding the asset beta of garden center business. So what we are going to do is, just a minute. Sorry. So what we are doing is we need the total cost of equity, right? Now the equity has the new business, as in the new cost of equity will have to reflect the beta of the old business as well as the beta of the new business, okay, in the proportion of the assets. So first off, we remove the financial side effects and just calculate the asset betas of both. So asset beta of just garden business is, if we calculate, is 0.72. Okay, we have everything. We have value of equity, we have value of debt. We can calculate asset beta that way. We have the equity beta also, which is given in the question. It D208. Oh, okay, I've mentioned it here, but this is from the question again. All right. So we have everything. So very simply, just by using the formula, I've written the formula over here. So just by putting the formula, putting the variables in the formula, you arrive at asset beta. So far, everything is pretty straightforward. All the information was almost given. The only challenging part was not even challenging because it's already given. Everything is given. The spread is given. All you had to do was add. Okay, so as long as you know you have a sense of direction as to how to tackle these questions. Okay, information is given. There is no trickery so far in the question, at least, right? Nothing that oh, this you had to keep in mind or something of that sorts. Very straightforward, to be honest. Um, so you found the asset beta. Now you are saying that the outdoor business asset beta is the garden center's asset beta is 0.72. Outdoor retail business is 0.88. Let me just check if there is any gearing on that. Is the asset beta given? Okay, they have very clearly given us the asset beta of a similar company. So it's not given us the equity beta, they have given us the asset beta. So you don't even have to ungear that beta, okay? Directly given the asset betas to us. So yeah, we have the okay, we have the asset beta of the outdoor retail business. We have the beta of the asset beta of the garden center business we just calculated above. Okay, oops, right, and we have the non-current assets, same proportion. So weightage has been calculated that way. Okay, and as per that, we have calculated our WAC. Not WAC, but weighted average of the asset beta, right? Because we are weighing, they asked us to weigh the business in the proportions of the non-current asset. So we found the proportions of the non-current asset, and based on that, we are finding the average asset beta, okay, which happens to be 0.76. Now, using this average asset beta, we will put it up in our new debt to equity. See, equity remains the same, okay, but debt increases. It's 46 plus 65, okay. So we are adding the two debt because we are raising new debt, okay, and VD1 minus T, and then with this we have all the variables. So see, you could either individually show it or you could do a direct calculation. I've just shown it individually so that it's easier for you to understand. But with practice, you need not spend time writing all these information. You can just directly do this calculation and get your answer, okay. So doing that, we find that the revised cost of equity is 15%. I've highlighted all the important answers that we get. Okay, so 15.1% over here. Now, simply just put it in our format for WACC, and you will arrive at 10.3%. Okay, super simple. The tricky bit would possibly be this, that you were to weigh it as per the proportion. In fact, it's not tricky, it's given in the question. And that's it. All the calculations are done, and we have the revised cost of capital is 10.3%. Now, if we just see what are the changes that is happening after raising debt, you can see there is a marginal increase in WACC from 10.1% to 10.3%, which means that the cheapness of debt was not able to compensate for the rise in cost of equity. Nonetheless, if you see that initially our equity was 75%, it's dropping to 55%. So still, we are in a comfortable way. It's not like a lot of financial risk. If you see that the cost of equity is increasing from 12 to 15%, which is kind of fair. Um so that's what the conclusion was talking about, that the financial risk isn't that high. Having said that, cost of equal, like if you see, if you remember the traditional theory of capital structure, it says that to begin with, the cost of equity would sorry the overall WACC would drop as debt increases until unless it reaches its optimal point, and then once beyond the optimal point, if debt increases, then the cheapness of debt will not be able to compensate for the rise in cost of equity. So it is evident that we have passed that optimal point. So possibly the rise in debt is not able to compensate, or the rise, since the debt has grown, the cost of debt is lower. Look at it, it's just 4.1%, okay, or around 4 to 5%. Okay, but the cheapness of debt is not able to compensate for the rise in cost of equity. And overall WACC is marginally increasing to 10.3%. So it's a 20 bips up move in the cost of capital. Okay, nothing major though. So that's how we would write the conclusion. You could have a look at the conclusion again. And this is all the theory questions which we already discussed when we were discussing the or reading the question. Okay, so you can, what I'll do is I'll just quickly keep this for you on the screen so you can pause and read. Okay, pause and read, and pause and read. Then pause and read, pause and read, pause and read, 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 and read again. And with that, we are done. I'll also show you the conclusion very quickly. Sorry. Just read through the conclusion to get a better idea. From bondholders' point of view, from equity holders' point of view, here we are talking about that lesser returns. Okay. And then the assumptions that we are making, just read through these on your marks, the professional marks, about cost of capital, which is the main focal point of the report, and our calculations and the introduction. All right. So we'll take a quick 5 minutes break, and we'll meet for the next question, which we'll do quickly again. All right. 5 minutes break. Yes. Right. Let's begin. Question number two. Um, Now, due to a little bit time crunch, we will just do the calculation bit, and theory uh, you could just read through. I'll send it across. The following exhibits available. Again, these are the exhibits available. Requirements explain why a regulatory framework related to mergers and acquisition is necessary to protect the interests of shareholders and other stakeholders. 5 marks. This is a pretty straightforward, a very kind of like a generic sort of question. Discuss the two theoretical propositions as raised by Lala's board of directors in relation to companies' capital structure. So this has to do something with the capital structure theories. So now we don't know what propositions they are talking about. Sounds like M&M. Okay. Probably you could talk about both their theories that they came up with. First was without tax, wherein they said it's immaterial, whichever you use. You take more debt or more equity, whatever it is, overall WACC will not get impacted. It doesn't change due to capital structure. And therefore, the market value of the company would not change due to the capital structure. The value would only increase if you are taking positive NPV projects. And the second proposition then said that, oh, debt is cheaper due to tax shield, and you should just take 99% debt or 99.9% debt, and that will be the best thing to do. That will reduce your WACC because cost of debt is cheap, and therefore it will additional debt is going to result or contribute to a lower WACC. And then there is the traditional theory, which is kind of something that makes a little more sense, is saying that initially the cheapness of debt will compensate the rise in cost of equity, but after a certain point, the WACC will go up, and in fact, after too much debt, even cost of debt will go up. Okay, which kind of makes sense. So you could talk about capital structure theory again, pretty simple theory question. Prepare a report for the board of directors of Lala company. Estimate the value of each Kava company share if it is demerged and listed as an independent company. So if we are demerging it and listing it independently, then what would be the value of Kava company per share we want? Remember, not the value of the entire company, but per share price. Estimate the additional equity value created when combining Lala and Kava. um, Percentage gain to each Lala company and Kava company shareholders under each payment group, the impact of Lala company's capital structure under each payment method. Evaluate the financial and other factors that both Lala company shareholders and Kava company shareholders would consider prior to agreeing the acquisition and the impact of Lala company's capital structure and the payment methods. Okay, and then 10 marks for commercial acumen. Introduction. Chakula Company is a large listed company involved in two business sectors. Its main business is in the production of food and drink for supermarkets and other large traders. It also owns a chain of coffee shops nationwide. Chakula board of directors think that the company is undervalued and is of the opinion that it should focus on rapid innovation taking place in the food and drink production sector. So it feels it is undervalued. It is a listed company already. It has two separate businesses, so some diversification is there. Therefore, Chakula Company's board of director has decided to unbundle. Okay, so unlock the company that way, since it's undervalued. So when they split the company, the valuation of the company would increase. So they are suggesting that they unbundle the coffee shop into a company called Kava Company, and Chakula will either demerge Kava through a spin-off or a sell Kava company. So either they can spin it off as a separate business entity and list it, or they can sell Kava to another player altogether. Chakula will then turn its full focus on the remaining business of food and drink production. Initially, Chakula's shareholders will own Kava company on basis of owning one Kava share for every Chakula share owned by them. So the moment you demerge it, every existing shareholder of Chakula will get 1:1 ratio. Okay, one share of Kava as well. Now they are talking about another company called Lala Company, is a large unlisted company controlled by 20 shareholders who all have a significant stake in the business. So this is unlisted, it's closely held, only 20 shareholders all having a good stake. Lala owns a number of hotels and around the country and is looking to diversify into coffee retail business. Lala Company has approached Chakula Company about the possibility of purchasing Kava. Lala Company will finance the purchase either through a cash only offer or a share for share offer. Now, see, a cash only offer, the benefit is that at least Kava Company knows how much they are getting. When it comes to share for share, do understand that Kava will belongs to a listed player, and even if it gets demerged, it will eventually get listed, or when it gets pinned off, it will end up having its own listing. Okay, but Lala, on the other hand, is not a listed company, so we don't know whether the, like, you could be a skeptic over here and say that maybe, okay, this is before doing any calculations, but just maybe one of the factors that you may want to consider is the Kava company shareholders may not necessarily like to own a non-listed or be a part of a non-listed company. Okay, um, so that's just some skepticism. If Kava company is demerged, it will be listed on the stock exchange as an independent company. Chakula company is unsure whether to sell Kava to Lala or demerge it as an independent company. So Kava, if it is demerged, it will get listed in the stock exchange as an independent company. Now, areas for further clarification. Further clarification has been sought by Lala Company's board of directors on the following two areas. Lala CEO has determined that the regulatory framework in the area of mergers and acquisition is designed to protect the interests of the shareholder and other stakeholders. She wants to find out why there is a need for a regulatory framework. See, a regulatory framework for mergers and acquisition is to protect the minority stakeholders, to ensure that um, uh, the merged entity does not have a lot of market share. It's to protect the interests of various stakeholders, but they are asking us in particular interests of shareholders and other. Okay, they are asking us shareholders as well as stakeholders. So you could talk about that. It's a pretty straightforward question. Okay, the need for regulatory framework. The acquisition of Kava Company will be a major investment for Lala, and its board of directors has concerns about how the acquisition will be financed. The board of director has heard that there are several theories explaining the capital structure of a company, including the two propositions. A company could maximize its debt financing. This is M&M's theory. Okay, that 99.9% debt, we discussed it when we were reading the requirements, and too much debt can be harmful to a company, and there needs to be a balance between equity and debt financing, which is the more traditional theory or the more practical one. Okay, that yes, if you have too much debt, then in fact even cost of debt would increase. Okay, and there is a possibility that the cheapness of debt may not be able to compensate for the rise in cost of equity, because cost of equity will rise the moment financial risk increases, and financial risk increases whenever the cost of debt will go up. Okay, or not not only the cost of debt, but if the proportion of debt also, if you just take more debt, financial risk goes up. That is, if your gearing of the company increases, then financial risk would increase. Okay, so again, pretty straightforward. We You have to write. So I think both the two theory questions are relating to this. This is from Lala Company CEO, and this is from Kava Company's, sorry, no, actually both are from Lala Company CEO. Okay, so yeah, this is pretty easy. Then moving on, Exhibit 3, capital structure details. Extracts from Chakula's company financial statement are as follows. Asset less current liabilities is being given. Share capital is given. This is the book value, and we have the face value per share. So we could just do 1000 divided by zero point 0.5, and we can arrive at the number of shares. Reserves are given to us. Non-current liabilities are available. Loan notes A, loan notes B. There's some information with regards to nominal value. Okay, nominal value is $100 per loan note. Okay, So they have, wait, let me, instead of doing that, let me just see how much space is available. Just shift it. Just a moment. Okay. Yeah. So through this, with the net, yeah. Okay. So through this, we can find the number of loan notes issued. We have the book value, we have the face value. So 2470 divided by 100 and 360 divided by 100 will give us, keep in mind these are $1,000,000. So we can get the number of loan notes issued if we need. Um, Chakula shares are trading at $2.45 each. So we have the market value of Chakula shares. So we can find, once we have the number of shares, we can multiply it into $2.45 each and find the market value of Chakula, or the market cap of Chakula. That is number of shares into price per share, market price per share, and have an equity beta of 1.3. The part of business which will become Kava accounts for 24.5% of Chakula's total equity value. So we know that out of the total market value of, or the market cap of Chakula, 24.5 is of Kava. So the moment that gets demerged, it gets reduced that way. Okay, Chakula loan notes A currently have a total market value of $2.1 million. So we know that this is worth $2.1 million market value. And loan note B currently have a total market value of $400 million. Uh, so this loan note B is of 400 million market value. So market value of equity can be found, and market value of bonds have been given. The pre-tax cost of debt has been determined to be 4.3% of loan notes A and 4.1% for loan note B. After unbundling, loan note B will be serviced by Kava and loan note A will remain with Chakula, but the pre-tax cost of debt for both will increase by 0.3%. It is expected that Kava will maintain its capital structure after the unbundling. So Kava, this loan will go to Kava, and this loan remains with Chakula. Um, and the equity split is also given 24.5%, and the balance is with Chakula. Now, they also mentioned that despite the cost of debt being 4.3 and 4.1, it will increase to 0.3 after the unbundling. Okay. For whatever reasons, possibly that the risk is increasing, or um for whatever reason, anyways, zero point 0.3, it increases, it's given to us. Um, Lala company's debt to equity ratio, just a moment, let me just fix this a little. Yeah. So Lala company's debt to equity ratio is estimated to be 40 is to 60 in equivalent market value terms, and it has a 1.2 million shares in issue. So based on this, at least you can find out the number of, or you could find, if you have the value of shares, you could find out the value of debt using this ratio 40/60 for Lala. The coffee retail business is dominated by Booney Company, a large listed company which owns many coffee shops around the country. The average asset beta of the coffee retail industry is 1.15. So again, we have been given the asset beta already, so we need not ungear anything. And this is the asset beta of the coffee industry. Since Lala is not listed, it does not have its own beta. All companies pay corporate tax of 20% per year, and tax is payable in the same year as the profit is based on. So there is no delay or lag. The risk-free rate of return is estimated to be 3%, and the market risk premium is 7.2%. Again, we have the premium and not the market rate. So this is RM minus RF. So RM minus RF is given, RF is given, tax is given, beta, asset beta of coffee business is given, equity beta of our current company is given as 1.3. Okay, so a lot of information is already given. Now, Kava company as a demerged company. The following estimate information will be applicable to Kava if it is demerged. That is, Chakula company's sales revenue is $4.5 billion currently, of which 20% is attributable to Kava company. So see, um, from the valuation point of view, Kava is 24.5, but from a revenue point of view, Kava contributes 20%. It is estimated that after Kava companies demerge, its annual sales revenue growth rate will be 6%. So after demerger, it will keep growing at 6%, and the profit margins before interest and taxes, so EBIT or PBIT, would be 21% of sales revenue for each of the next 4 years. It can be assumed for the current tax allowable depreciation will remain equivalent to the amount of investment needed to maintain the current level of operation. So basically, there is a setting off a neutralizing effect from depreciation. So whatever the depreciation is, that much asset you are purchasing. So it kind of neutralize each other. So it's like you would do less depreciation and then because it's a you would do add depreciation because it's a non-cash expense, and then at the same time you are investing, so there is an in outflow also of the same amount, so it kind of nullifies each other, so need not mention either of them. But the Kava company will require an additional investment. So beyond that, we need to invest more, and that is 25 cents for every $1 increase in sales revenue. So this we would need to show, but the other one, as I said, has a neutralizing effect, so need not necessarily show that. You could, but then it just cancels out each other. And in fact, no information about depreciation or that is given. So we honestly don't know how much to take as depreciation then. After initial 4 years, the annual growth rate of the company's free cash flow is expected to be 2.5% for the foreseeable future. So this is your terminal growth rate, which is possible. 2.5%, the economy may grow at that rate. Again, depends on what growth rate you are expecting the economy to grow at, but 2.5% seems fairly reasonable growth rate. Exhibit number 5, and we don't really know in which country this companies are from, but 2.5 seems reasonable. Exhibit number 5, acquisition of Kava Company by Lala. The following estimated information applies to the acquisition of Kava Company by Lala if Kava is acquired. The average PE ratio for the hotel industry is 15.61. However, Lala Company's PE ratio is estimated to be 10% lower than this, possibly because it's unlisted, so there is a discount to the PE multiple. Extracts from the current statements of profit or loss applicable to Lala Company and Kava are as follows. So we have our what do you say? EP like profit after tax available to us. After this, after the acquisition, it is expected that the PE ratio of the combined company will be the midpoint between the two individual companies' PE ratio. So midpoint is basically a fancy way, not a fancy way, but another way of saying the average. Okay, so all you have to do is add the two PEs and divide by two. The annual after-tax profit will increase by 62 million due to combining the two companies. So we are seeing some revenue and cost synergies. So the combined profit will be 171 plus 117 plus $62 million. Lala Company has proposed to pay for acquiring Kava Company either through a cash offer or 0.66 for a Kava company share. So 66 cents for per share is what they are willing to pay, or one Lala company share for every three Kava company shares. Lala company will borrow the money needed to pay for the acquisition. So Lala does not have the cash reserves to make this acquisition. If they have to pay cash, they will borrow it. Or else they can do a share for share deal, which is 3 shares of Kava will be taken, and against it, 1 share of Lala will get issued. So we need to really find out the value of Lala and see what sort of valuation Kava company is getting. Okay. So let us just list down whatever was given to us. Chakula company share price, number of shares of Chakula we could calculate. Okay. Then number of wait, just a moment. Yeah. Then the number of shares of Kava company we have calculated based on that because it's 1:1 ratio. So let me just write it 1:1 ratio. Okay. 1:1 ratio. Therefore, the number of shares would remain the same. Wait a moment. Sorry. Then market value of Chakula. We can find out we have price per share, we have number of shares, so we can find out the market value of Chakula. And they mentioned that Kava is 24.5% of the market value of Chakula. So we find out the market value of Kava based on that. Kava company share price is also been given. No, sorry, not given. We are calculating it. So the market, since we have the market value of Kava, and we know the number of shares in Kava, we find out that Kava company share price is zero point 0.6. So it's right off the bat, we just remember that there is a cash offer of 0.66 per share. So that means there is some growth over there. Okay. Equity beta of Chakula is 1.3 given to us, and Lala company's debt to equity is 40:60. How do we find that 40:60? Well, we know that, or I think Lala company's debt to equity was given. Wait, let me just check. Can't recollect. I think it was given. Yeah, it is given over here. Okay, Lala company is 40:60. 40:60 Lala company. So this is how you should ideally make the financial summary. As and when you get information, you just write it down. Number of equity shares of Lala company therefore is 1.2 million, which is given, which represents the 60% of it. Okay, asset beta of coffee retail business is 1.15. Now, appendix number 1, estimating cost of capital of Kava, that is after demerger. So we need the WACC, basically overall cost. For that, we first need to find the. So this is how the we find our. Wait, let me just. Okay, so this is how we calculate our WACC. We need market value, we need cost of capital, and the weightage. Weightage is based on the market value. That's why we need those market values. Okay. Right. Why have I left a gap here? Anyways, is it visible? Yeah, visible. Okay, leave about the gap. Um, so yeah, market values we have available. We already have the market value of Kava company. We have the market value of debt. It's already given in the question. Okay, so market value of debt has been given. We need to find the post-tax cost of debt, and we need to find cost of equity. Now, post-tax cost of debt again is given, if you remember, 0.3% increase in debt level. So if you see post-tax cost of debt is, we know that pre-tax cost of debt is 4.1%. Okay, and this 4.1%, another 0.3% grows in it. Okay, so that results in 4.4%. And post-tax cost of debt is 1 minus T. So you're doing that and you find out the post-tax cost of debt. You could either show it this way or you could do all of this calculation over here, and that would just suffice. Okay, because it's pretty self-explanatory. Debt cost of capital, what it is. Okay, so it's 3.5%. Now, cost of equity we need to find. For cost of equity, we have been given. We need the equity. Wait, yeah, the equity beta was not available. We have the equity beta of the entire company and not just Kava. So cost of equity would be, as we all know, the CAPM model, risk-free rate plus equity beta plus market risk premium. Now we have market risk premium, we have risk-free rate. We need to find out the equity beta. We do have the what do you say, asset beta for coffee retail business already available to us. So we can take that, since Kava is a coffee business. So we are taking the asset beta of a coffee business. Okay. And then we will have to re-gear it as per Kava's capital structure. Right. So we are re-gearing as per Kava's capital structure. So we know that the market value of loan notes is available to us. And we know what the equity part is also, 1,201. Okay, so numerator is equity, denominator is so M, what do you say? Sorry, we are finding equity beta now, so it will be the inverted formula. So asset beta is equal to equity beta into value of equity. So value of equity is a numerator, but now we are finding the equity beta, not with the asset beta. So actually, this has been, yeah, this comes here. Okay, asset beta for coffee retail is 1.15, and then we find the equity beta, or sorry, we find the equity beta of Kava company by re-gearing it. So we have the value of equity, we have the value of debt, and we therefore calculate. So this is value of equity plus value of debt, 1 minus T divided by value of equity. Remember, since we are finding equity beta, the ratio gets inverted, and into asset beta, which we already have. So that gives us equity beta. Now that we have equity beta, we can find cost of equity that way, right? Pretty straightforward then. So we input our cost of equity. We already have the weightage since we had the market values. Find out the WACC. So WACC is around 11%. You could show it in decimal form also. Okay, it's exactly 11. Wow, okay. It's exactly 11%. Right? Just show one decimal at least, so 11.0%. Current sales of Kava, we know that 4,500 into, we are factoring a 20% growth. Sorry, 4.5 million was the total sales of Chakula, and 20% is resulting from Kava. So that's the reason why it is $900 million. And then there is a growth rate of 6% in the sales revenue, and the margin or the profit before interest and taxes is 21% of sales. Okay. Additional asset investment we know is 25 cents per every $1 increase in sales. Cost of capital is 11% that we have found out from above. Okay, 11%. So that's our discounting rate. And per year free cash flow growth rate for the first 4 years, after the first 4 years, or the terminal growth rate is 2.5%. You can just write this as terminal growth. Right? So you have your cash flows mentioned. I don't know why have we increased this particular. Let me just bring it smaller because okay, is it visible? Little bit. Okay. Don't worry, I'll just scroll up and then you can see what is written over here completely. Okay. But yeah, let's just focus on this. This is nothing. I'm just okay, let's just do this first. Okay, get this out of the way. This is nothing. This is just a standard way in which free cash flows are calculated. Free cash flows to the firm. You start off with the EBIT or PBIT less taxes. Then you add any non-cash expenses like depreciation. Then you reduce the change or increase in working capital. You reduce capital expenditure, that is an outflow, and then you arrive at free cash flow. This is just the standard pro forma of it, which we are following over here. So we start off with PBIT. We know that there is an increase of how many percent? Sorry. Yeah, 6%. So it was, as of today, it is 900 million, and from year one onwards, it's growing at 6%. This is when Kava is demerged. Okay, then we have the PBIT, which is 21% of it. So we are doing that, 21% of the sales. Tax paid in the same year, so no arrears, 20% of it. So 20% tax is paid. Then we have, in fact, yeah. Then they said that 25 cents for every $1 increase in sales. So for that, we need to find out what is the increase in sales. So it's nothing but the difference between the current sales and the previous year's sales. So in this case, it's 54, 57, 61, and $64 million. And then we find out the additional capex. So it's 25 cents for every $1 increase. So it's just kind of like 25%. Okay, or it's an outflow, so less. And then that's how we find our free cash flows. So PBIT less taxes. There is no depreciation in the sense that you would normally do add depreciation and less capex. But since these two are the same, so it kind of neutralizes each other out. But there is an additional capex which we consider individually then. Okay, so that's it. Three cash flows that we are considering. And then we say that from year five onwards, this cash flow grows at 2.5% forever, for perpetuity. Okay, so first, the implicit valuation or the present value of the implicit cash flows is $494 million. To that, you have to add year five's, you have to add the terminal valuation. Okay, so you know the terminal growth rate is 2.5%, which we get from here. Okay, free cash flows for year five is 175, and then it's kind of growing at 2.5%, so 179 as on year five. And then you can do a perpetuity discounting if you want over there. So the formula is the cash flow into 1 divided by R. Now, since there is growth, so it will be 1 divided by R minus G. R stays to be 11%, which is the cost of capital. Okay, so I'll just show you what our cost of capital is. We had calculated it. It's 11%. Okay, so the terminal value, yeah, this is just a small chain because probably it's not exactly 11%. So anyways, I will just do that change. Okay. So this is the value of, the terminal value of the company. Now you will add the terminal value and the implicit, okay, one more thing. This is very important. Okay, just keep this in mind, the double discounting that we do. Okay, you can in fact write down the annuity factor, discounting factor. Let me write that discounting factor. 10%, 11% fourth year. Okay, because it's a case of delayed perpetuity. So the perpetuity starts from year five onwards. So when you discount it, you will find the value as on year four, and then you have to find out is equal to 1 divided by 1 plus 11% raised to 4. Okay, this is not dollars. This is a discounting factor, right? So you can just do as an alternative calculation. It's just this into the discounting factor, 1385. Okay. Just an additional disclosure for your better understanding. So it's double discounting. Remember that. So remember, sorry. Do not forget this. Okay. So $1,389 million. Right. Now the total value of Kava, therefore, is the summation of the terminal value as well as the explicit value. Sorry. So $1.8 billion company, Kava. Value of equity value of Kava, that is post demerger. Now, since you know the total value of, you know the weightage of Kava. Okay, the equity weightage is 75%. This is total value. Okay, that is equity plus debt. Now, since you know that this is 75%, so now you understand that only equity component is $1.4 million. Okay, this is how we get our, this is exactly the capital structure of Kava, right? And it's post demerger. So from there we get it, and we find out the equity value of Kava company. Number of shares we already know is 2 million, or sorry, 2,000 million or 2 billion shares. So per share value of Kava, that is after demerger, becomes 0.71, and before demerger we knew was 0.6. So therefore the gain, okay, is 18%. We can maybe increase it 17.7 or 18%, whatever. You can keep it as 17.7. Okay, so we know the gain is 17.7%. So for demerger, the shareholders are making 17.7 or 18%. Now, if you are selling Kava to Lala, then what is the value of the company, the combined value of the company? So Lala's PE ratio, they have point. Wait, is Lala's PE given? Combined PE is given. Okay, they have said that it is industry PE is 15.61 and Lala is 10% lower. So it is basically, you could directly write 0.9 or you could do 1 minus 10%. Okay. You'll get the same PE multiple. So this is 14.05 times, or just keep it as 14 times. Okay. Price of equity of Lala company, therefore, so you have earnings available, you have the PE multiple available, earnings is available in the question. So this is Lala company's earnings. So therefore, you can find the value of market value of Lala company, and then you know the okay, using that same valuation technique, that is finding PE multiples. Or no, you have the market value. Okay, so yeah, we have calculated that previously. Before merger, the value of Kava we have. This is pre-acquisition. This is also pre-acquisition. Okay, so pre-acquisition prices we have. Now PE of Kava, we can find out. We have the price, we have the earnings. Okay, from the question, and based on that, we can find out the PE multiple of Kava. Now we need to find the average PE, because they have asked us that the combined company's PE is the midpoint of both. So average PE, okay, or midpoint, is 12.15. It's nothing but adding up the PEs and finding it out. So 12.5, 12.15x, okay, or 12.2. Combined PAT of merged entity, well, we know that there is some synergy benefits also. So the two individual, sorry, just a moment. Sorry about that. So we know the two individuals' profit after taxes, and then we know that there is synergy benefit of 62 million, so which we are adding to it. Okay, so 350 million, and then we are valuing on basis of PE multiples, and we arrive at the combined value of the company to be $4.2 billion if the merger happens. Okay, so if you have to find out what is the value of the synergy, so the combined value minus the individual values will give you the value of synergy, which is $651 million is due to synergy. Now, if you look at share offer, what is happening is 66 cents per share. There are 2 billion shares. So cash received is this into 0.66 is equal to 1.32 million, or sorry, $1.3 billion. Uh, Otherwise, before acquisition, it was worth 60 cents a share. So they are gaining only 10%. But if they demerge, they are getting 17.7%. If they do a share for share deal, then estimated Lala company's total shareholders value would be wait. Okay, this is if you go for cash offer, I think. Wait a minute. Yeah, this is all cash offer. Share for share is shown below. Okay, the spelling is wrong. Yeah, sorry. So if cash is being offered, then this is the cash that they have to pay. If the combined entity's value is $4.2 billion, okay, out of that they have to pay a cash of $1.3 billion. So the combined entity will be 2.9 billion. Now, number of shares of Lala company, that is pre and post acquisition, will be same, which is 1.2 million, which was given in the question, and estimated because it's a cash offer, right? So no new shares are issued. It will be the same even post acquisition. And this is just the cash outflow, the total worth of the company, the combined entity, and then in order to make that acquisition happen, they have to pay cash. So cash will go out, right? That's why we are reducing it. Now, estimated Lala company's total value per share, just divide the two, you will get the price per share of Lala company. So from Lala company's shareholders' point of view, they are gaining 22% in this whole deal. Because before acquisition, they were worth $2 a share. Okay, we can find it out because we know the pre-acquisition valuation and we know number of shares. Okay. So 22% shows how unfair it is for. So basically, not only unfair, but it kind of shows that Lala company can pay more if you can negotiate, because they can. Firstly, Kawa company shareholders will reject it because they would otherwise get 17.7 on demerger. Okay, so why settle for 10%? So they are going to negotiate for a better deal. And if you opt for a share for share deal, so then the number of shares for Lala pre-acquisition is 1.2. Additional shares that it has to issue is, now they have given you the ratio. For every 3 shares, they are going to issue 1 shares. That means they are going to issue 667 new shares. Okay. How many shares of Kava is already there? That is 2,000 million shares. Okay, so 1/3 of that is going to be issued. So the new number of shares will be the summation of these two. 1.8 billion shares will be in circulation if it is a share for share deal. Now, estimated equity value of the combined entity we have found. So per share price is 2.28, okay, per share of the combined entity. Now, if they are giving 3 shares to each, sorry, they are issuing 1 share for every 3 share. That means the total shareholders of Kava is receiving 667, because that's the total new issue into $2.28 a share. That is, they are getting $1.5 billion in return, which seems a little more than the cash. Is it? Where's the cash offer? Yeah, cash was just 1.3 billion. This is 1.5 billion. Okay, so definitely more. Value of 3 shares given up to Kava is $1.8, what they are paying. Okay, see, you can't compare 1 share to 1 share, because in exchange for 3 shares, they are getting 1 share. So you are finding the value of 3 shares. Okay, so 3 into 0.6 which is the value of Kava company share. Gain of Kava company shareholders per share is then 0.48 cent per share or 27%. Okay, which is definitely more than 17%. Okay, so they can consider this offer. However, we can highlight the fact that would they be okay to take shares of a non-listed player, right? So 27% is gain on acquisition by shares, and for Kava company and from Lala company's point of view, it is 14%, which we are comparing this way. Pre-acquisition, they were worth $2. Now they are worth $2.28. They are getting 14%. Okay. Also, you can highlight the fact that in case of share for share deal, okay, there could be another what do you say factor to consider, that we don't know whether the synergy benefits would arise. We don't know whether the company would do well. We don't know whether the share price that we are estimating would actually materialize or not. See, cash is certain. It's hard cash given to you right now. But when it comes to share for share deal, we don't know what the future share prices would be like. And especially if it is a non-listed company, liquidity is also an issue, as in if you want to sell off these shares, it will be a little tough for you. So highlight these things. So though it is 27% looks financially great, but these are other factors you may want to consider. And maybe you could suggest that you could do a 50-50, like a better cash deal, and like partially cash and partially equity. Not given in the question, but you could suggest for it. Estimate the impact on capital structure of Lala from both the payment option. Now, I don't think this has been asked in the question, but or no, it is correct. Okay. So Lala company before acquisition, the market value of equity and debt is given. We have the ratios of it. Um, 60 debt. Okay. And we basically have market value of equity, and based on that, we are calculating market value of debt. That is for Lala. This is before acquisition. Now, after acquisition, what is happening? The combined company, and this is including the cash flow that is happening. So the market value, the equity value we have already found out over here. That is the total market value of the merged entity. Okay. And this happens to be 47%. We know the and then we know the market value. We find it out, market value of debt. We find it out this way, because old debt, okay, that is old debt of Lala plus the new loan, because for cash, if it's a cash deal, right? They said in the question that the cash is being arranged by taking additional debt. So whatever the cash component is, how much cash? $1.3 billion. That much they have to take as loan, and plus the market value of Kava company's old loan, that loan B. Yes, this one over here, $400 million. Okay. So all these loans together, and then we find out what the debt to equity ratio is. So we can see that the financial risk increases, and in fact, debt becomes more than equity. Okay, if you go for a cash for cash deal where you are taking additional debt. But when it comes to a share for share deal, the capital structure is better. In fact, financial risk has reduced. Um, but it just shows that there is more equities. Maybe cost of equity would go up. So in both the above cases, when two companies are combined, it is assumed that Lala company will continue to service loan notes B or cancel them by paying them off through an equivalent borrowing. Okay. So yeah, here there is no cash, so you are just adding old debt and Kava company's loan notes. And value of equity we have already found, so that we can take for share deal what it is. Right? And then this is how you can write the report. Okay, here now if you see, the structure of the report is slightly different. Now you can use either of the structure, but keep in mind that introduction. So previously I wrote to, from, and subject. So from here, just the to is written over here, report to the board of directors of Lala company, and from is basically at the base. I think this is a better structure that you could follow. So report compiled by, so it's basically from, and then you have the date. There's no subject line. There's immediately the introduction. The report evaluates and discusses. As I said, you could pick up the introduction from the requirements. Okay. And then factors to consider, capital structure. Now, I haven't written it all down. I'll give you the solution and you can have a look at the entire way it's written. But these are the headings that you need to put in: the factors to consider, capital structure changes, and the conclusion. So we'll just go through the conclusion and we will end. The share for share exchange gives the highest return for Kava company shareholders and also makes a good return for Lala company shareholder. The impact on capital structure from this method is a higher percentage of equity and therefore the scope to raise more finance through debt or can raise more debt because the capital structure is comfortable that way. How make the cash payment method the preferred one for Kava shareholders. The current, so first paragraph is just stating the obvious, that the percentage in share for share deal is good. So you would go for it. And the other advantage is, since the debt to equity structure is also better, uh, that means you can raise further debt in future easily. Okay. However, having said that, Lala is unlisted and therefore the Kava company shareholders may prefer cash, though the current cash offer is less than the value generated from the demerger and therefore unlikely to be accepted. Therefore, a cash offer to match the benefit from the demerger would need to be made. The initial cash offer and a higher revised cash offer would have a significant impact on Lala's capital structure in terms of increased debt. Therefore, it is recommended that Lala should consider equity financing through a partial listing. This would also enable Kava shareholders to trade their shares and thereby make the deal look more better for them. So our suggestion is that, see, we just state that Lala would be inclined towards share for share. Sorry, Lala company would be inclined towards cash deal. However, the cash deal doesn't seem adequate as it is lower than if it would demerge. Kava would demerge. So Kava company shareholders is going to outright reject it. Now, to make an increased cash offer, it will take a little more debt, and we already saw that the debt to equity structure is all any which ways with the current offer being in poorly impacted. So if you just increase that cash component, which results in more debt, so we suggest that instead of taking more debt, why not go into listing the company? And that also works in favor of Kava company because now that the company is listed, they can also exit in case if they want to take an exit that way. Like if even if partially they are given shares and if they want to exit those and want 100% cash, they have the opportunity to do so. And then you are writing the report. Okay. Now regulatory frameworks you can read through. Okay. This is subsection A, subsection B, theory question. All right. And with this, we are done. This was the last day. So, all the very best for the exam. I hope the 5 days got some value to you. Um, Thank you all so much for your time for attending these 5 day sessions. I'm glad that you liked it, and thank you for all the feedback you have given us. God bless you all, and all the very best.